As the lights of festivities sparkle across the country, we are celebrating a quarter century of Samvats here at CNBC TV 18 as we turn 25. Here's wishing everyone a very happy Diwali.
And what a prosperous one it's been, a 30% rise in the Nifty alone, with SIP inflows at record highs. But just as we take our break from our hectic routines, the festivities give us a moment to pause and reflect. It seems like the markets too are shifting into a lower gear.
Absolutely. The question, of course, is this just a speed bump, a slowdown, or maybe even a chance to step in? After a long euphoric run, questions are emerging before we bring in our star-studded Samvat Townhall, as we're calling it, to answer and debate all these questions. Let me actually quickly put some perspective and some points on the table. First up, while starting valuations have been pretty high, we have been seeing earnings downgrades at the same time across the board. The MSCI India index is currently trading at 24 times forward earnings. That's at a level we've only seen twice in the recent history, 2007, 2021. Both times, the markets were riding high, but we all remember the corrections that followed. Relative to other emerging markets as well, in the region, MSCI India is also running at a significant premium. The current PE premium is 70%, a steep jump from the 5-year average, which is 55%. This is some investors wondering if the market's recent exuberance has gone a bit too far too fast. We've also had a weak first quarter and an ongoing Q2. Analysts are asking if H2 recovery will materialize. A lot depends on this festive season. Let's get to flows. Domestic mutual funds have been stepping in to prop up the markets. They've bought nearly $10 billion month to date, effectively countering the $10 billion sold by FIIs. Now, starting cash balances at mutual funds were about $17–18 billion. Add to that the monthly inflows into equity schemes, which has been around $4 billion. But there's a massive pipeline of equity issuance, IPOs and whatnot. The question many are asking is, if FII selling continues, will mutual funds run out of dry powder soon? And of course, we can't ignore the bigger global backdrop, the outcome of upcoming US elections combined with the impact of ongoing global conflicts. These are still unknown, but they are looming. There are also some questions being raised by veteran US investors about how certain really we should be that the Fed's big interest rate cutting cycle will indeed materialize. Well, you're with us here on the Diwali Market Movers Forum, and we are in conversation with some of the top experts. Lots of questions, as we just told you. Let's welcome Naren, boss man at ICICI Pro AMC, and Nilesh Shah, boss at Kotak Mahindra Asset Management Company. They're both here. Gentlemen, please join us on stage. Thank you so much. Wishing both of you a very happy Diwali. Thank you so much for being here with us here at CNBC TV 18.
Wish all the viewers of CNBC TV 18 a very happy and a prosperous Diwali.
Wish all the viewers and all of you happy Diwali.
Thank you very much. Naren, let me start with you, because you've been for the longest time sort of calling for a bit of a sort of tempering of expectations, and the run that we've had in markets, we've finally gotten that at the margin a little bit. Are you satisfied or not yet?
No, it's not a question of satisfaction. I don't think we want investors to lose money because markets come down. That's not the case. See, basically what worries us, we are managing public money. So our job is to temper expectations. And that too, when you've had long periods where markets have not fallen, there are so many investors who believe that equity is like FD. And then, that worries us a lot. So that's why I think it's our job actually to temper expectations, particularly when expectations are going up and when markets are going up. See, particularly after March 2023, what happened was most investors wanted to only invest in equity and not invest in debt. And therefore, what happened was this cycle became more and more positive towards equity. And we could see over the last 3 to 6 months that first the challenge is that there is nothing wrong with India's fundamentals or something. So it is basically a valuation problem and a sentiment problem. That the sentiment problem is you have all these SME IPOs, you don't know what they have. internally, and you have a situation where companies whose balance sheets are weak, managing to raise money, any amount of money in the equity market, that worries us. But we can't predict markets, so it's our job to
Let me
temper
clarify when I say satisfied, I did not mean that. I just said that is it enough tempering of expectations, or you think it's going to be an ongoing thing?
See, if for example markets had already become a level where things had become cheap, we would we would move out of our call to keep on talking asset allocation and multi-asset and all that and move to equity. It has still not happened. Because if you look at where markets are, or look at even 1 year returns in small cap, mid cap or large cap, it is not low, it is still high. Maybe the markets have corrected in the last 1 month. But they have not. If you take the 1 year returns, they are still high, and the valuations are not cheap in any sense of the word. So that's why it's still not in a situation where you can come and tell people invest aggressively at this point of time. That phase is not yet started.
Nilesh bhai, you and your team have also been sort of ringing the caution bell for a while. I remember, I think you were also one of the early ones. Are we in a bit of a corrective phase which is likely to last a little bit? What's your sense?
So I wish I knew about the market like that. Otherwise, I would have said 1 month back only that now market will correct.
Right.
We know where the valuation is. Is it cheap? Is it expensive? Markets is like pendulum, kabhi idhar, kabhi udhar. So I have no idea where markets will go. But I know now valuations have corrected in many cases. And it's time to look at stock on a bottom-up basis.
So we started the month with about $16-17 billion of cash across the mutual fund industry. At Kotak, have you already deployed quite a bit of the cash?
So we never took cash call and we communicated that to our investor. We believe my partners are taking asset allocation call for their client. If I try to second guess them, then we'll end up having, wrong sequence. There are funds like multi-asset allocation fund or a balance advantage fund or asset allocation fund where we have taken allocation call between debt, equity and gold, silver. There is some marginal increase in equity allocation from, let's say, gold or fixed income. But that's marginal. It's not material movement.
Well, Naren, just to build on to the point that you made about FDs versus equities, right? For the last couple of years, it wasn't even an option. But going by the euphoria in the system, by the valuations as well, would you not rule out that, say, in the next 12 to around 24 months, actually a fixed income could outperform a mid or small cap fund? Could that be a possibility? Because the index itself has moved up by 3 to 5 times in the last few years.
It could be a possibility, but if you ask an average investor, the average investor is still very pro-equity at this point of time.
Right.
See, because you're not, you have to look at a 10-year history.
Indeed.
All the way from 2014, there has not been a down year. So, if you ask a typical investor, the typical investor is today not interested in debt or fixed income. The typical investor today is interested in equity. While we believe it is quite possible that FD can outperform small and mid cap, most investors today are really happy with equity as an asset class.
Indeed.
And that is the reality at this point of time. The challenge is, if you add a fundamental problem and valuations being high, it would be very easy for you to say that this would happen.
Right.
Today, you don't have a fundamental problem. You have a valuation and sentiment problem. And valuation and a sentiment problem is something that you can have situation where valuations can be high for a long period of time.
Indeed.
That doesn't mean that we are going to thump the table and say, put all your money in equity, because our goal is we manage public money. We don't manage our money. So our goal is to reduce investor expectation and try to get people to moderate their expectation and try to get people to invest in all asset classes and not take only risk. Because when they lose money, they tend to think that we are responsible for the losses. We are not responsible for the losses.
Right.
We are responsible. If people give us money in small cap, we'll invest in small cap. If they give money in mid cap, they will invest in mid cap. So our goal is to reduce investor expectation. Are valuations cheap today? I think barring banks where the valuations are reasonable, most other sectors are still not cheap. that we can give a positive.
So from a 5 to 10 year perspective, obviously equity is in the way, but maybe in the near term, fixed income could outperform just in the near term going by the valuations. Just one
There
more.
is one fixed income
Yes.
instruments which will outperform small and mid cap. The 50-year strip, if you can lay a hand on it. The 50-year strip will have 50-year duration, and if interest rate comes down by 0.5%, it will give you 25% return.
Wow.
So one fixed income instrument I'm quite confident will outperform small and mid
Why is
cap
it difficult to get your hands on?
because it's difficult.
But it's available?
It's available, but it's difficult to get because the long bonds are all with insurance and pension players. They don't sell in the market. But theoretically, in Indian market, we have a fixed income instrument which will outperform small and mid cap over next 12, 18 months.
Interesting.
Interesting. All right. Naren, just one more point, I think you're not attributing this nervousness more to a fundamental problem or the economy is slowing down. It's more the euphoria that's built up in the system. That's the bigger problem, it seems.
So you had a euphoria, you have some amount of euphoria, and top of it you had fair amount of IPOs. So you had a situation where the fundraisings had started to accelerate. So you have a situation, on top of it you had a situation where the FIs wanted to sell India to invest in China. So the combination of the three has resulted in it. It is actually, if you look at it, the biggest reason is what China did. That Chinese stimulus, the FIs were caught underinvested in China in a very big way.
Right.
They thought that China is a place where they don't need to invest for the next 5 to 10 years. And the valuation, if you looked at purely from a valuation point of view, China was at 9 PE.
Right.
But the problem was people were saying, no, we don't want to invest in China because China has deep structural problems. But when the stimulus was announced, most of the hedge funds, most of the foreign funds, they were caught napping, and they found India is the best place where valuation was high. They could sell the market. They could even execute their sell trades. Maybe in some of the other markets, they couldn't have executed sell trades. So they went and executed the sell trade.
Okay. All right, Nilesh, let me get you in on this. The domestic flows have been rock solid, and this equity cult has been built in India. And a lot of us are part of that. Could you tell us, according to your estimates or your analysis, how much of this FI selling is done? Because the broad outlook was $12 to $50 billion could be the readjustment that could take place because China has come back to life. Do you think the FI selling bulk of it is done? And also the domestic flows, they've shown the fatal now, which is very, very heartening. But how do you see that shape up?
So let me first contradict this statement that people are overexposed to equity. As per RBI's data of Indian financial sector allocation of Indian household, between FY21 and FY23, total money which came into mutual fund was 4 lakh crore. Total money which went into capital market, including bonds, debentures and equities direct, was 2 lakh crore.
Okay.
तो कुल मिला के 6 लाख करोड़ आया. The increase in currency in circulation was 9 lakh crore.
So, yeah.
9 lakh crore is in currency notes. I haven't got that money in equity yet.
Right.
93% savings of Indian, when they invest in financial sector, is negative real return or marginally positive real return. Where do you go and put money? Bank deposits, insurance, pension, currency notes and small savings.
Right.
You want to secure financial freedom, but you are only putting 7% of your money in real return product. 93% wealth does not create any return for you. How will you become wealthy?
Indeed. There's a huge scope for penetration here in India.
So in the domestic market, there is huge scope for penetration of real return product. It could be equity, it could be performing credit, it could be alternate.
Yeah.
And all those things will come over a period of time.
Mutual fund sahi hai.
Mutual fund sahi hai because this is one product where manufacturer, distributor and investor interests are aligned.
Yep.
So the
In some industry, it's tilted towards manufacturer and distributor. In some industry, it is tilted towards investor. But this is the only industry where everything is aligned together.
Yeah.
Right.
Now coming to China, how many investors would like to invest in a country where you don't know where their ex-defense minister and foreign minister are? Today we have no idea where China's defense minister and foreign minister is disappeared. How many people would like to invest in a country where last 10 years earnings growth in terms of CSI 300 index EPS is 10%? In renminbi terms, 1% a year. In the same time period, India's Nifty went up by 166% in EPS in rupee terms.
Right, from 400.
So on a price to earning basis, yes, India looks expensive.
For a
But
reason.
Obviously, and on a price to earnings growth, we are looking far more cheaper.
Yeah. No, absolutely. And maybe because we kind of, there's a little bit of adjustment which is happening, and that's okay.
ठीक है, सुबह का बुला शाम को घर लौट आएगा. कहाँ जाएगा?
That's a nice way to put it. You're a Naren, close watcher of macros, right? First of all, do you have any views on this? How much is tactically shifted? Is it mostly the bulk of it is done?
You know, people can say that they know when FIs will stop selling.
We don't know.
FIs is not one broad single group.
Correct.
There are hedge funds who wake up in the morning, short India, evening wake up and buy India. So these things no one knows actually.
Okay. What's the big dominating global stories? Because you're a close watcher of the macro cycle as well. What's going to be important to watch, in your opinion?
Clearly the US election. And we don't know what policies will be followed depending on who comes after the US election. It will have some impact. So if the real challenge at this point of time is India has had fantastic macro. So if you look at the most important indicator being current account deficit, then you look at fiscal deficit, particularly central government and inflation. We have managed to keep it very stable. That's why Indian tenure, the Indian government yields haven't gone up in the last 3 to 5 years. But look at the US situation. It is quite possible that after the US election, all of them will increase the US fiscal deficit. Then what happens to US yields? In fact, US 10-year yields have been going up. US 30-year yields have been going up. So what is going to be the macroeconomic impact of the US election? That is something, you know, surprisingly 10, 15 days before the US election, there's very little discussion on that, and it may have fair amount of macroeconomic implications on India. It's possible that the FIS sold India just to keep some cash for the uncertainty to deal with the US election. We wouldn't know it, and it may come back after the US election if they realize that there is no negative impact on emerging markets. Maybe that is the reason. That is clearly one clear thing. Second is geopolitical. We have seen 2 wars. Virtually the second is also like a war only if you see what's going on. Can that escalate after the US election? Because has the US government tried to persuade Israel not to escalate it ahead of the US election? We don't know that. So that is another important issue because oil has been very well behaved. If oil spikes up substantially, it has negative macroeconomic implication. That is the second, if you look at it. The third, I think SEBI has been correctly pointing out that the entire enthusiasm for the derivative market, which is there among local investors, is the third big macroeconomic thing. While the Indian government has managed macro very well, the extent of enthusiasm shown by the investors in the derivative market is a bit of a worry for the regulator. I think last week one of the members in television mentioned it has become a national pastime and it should not be. I think that is a real worry.
That has been addressed now, right? With the last...
it doesn't get addressed.
The weekly contracts, etc.
If the amount of activity still remains high... And
we will know once all these changes take effect, which is on the 20th of November.
But even today, as we speak, how did the quantum of selling get absorbed? A lot of it has been absorbed by the derivative traders in India at this point of time. If you look at the open interest in, you know, the entire people talk about how SIPs will save the Indian market, but the level of SIPs is much smaller than the amount of leverage which exists in the derivative markets in India. So I would say that is the third worry. So these would be the 3 things that really worry me at this point of time.